Oh, my name is Igor. In this channel, we discuss markets, investing, trading overall, economy as well. Today is the 7th of June, and what I wanted to point out today is a definite change of perception of the news flow in the market. In practical terms, that means that the market has learned to shrug off bad news very fastly. Remember the moment when everybody understood that tariffs are for real and what that meant. In practical terms, that meant that the averages were correcting for 10 to 15%. Man, it was quite scary at the moment, quite scary. But what happened next? Uh, Now we're getting news about negotiations with China, and they are quite difficult, as Donald Trump says himself. But not much reaction. At the same time, the next day we get uh, news from the courtroom, and all of a sudden tariffs overall are illegal, and we see a legal battle coming, which will likely drag on for months. Markets are largely indifferent to that. And finally, we see a conflict between Elon Musk and Donald Trump himself, and that is basically shrugged off for in a day or two. So, in practical terms, right now, that means that dips are viable or were viable during this week, and also breakouts are viable as well, and new IPOs are behaving good, and it's good news. And that means that short-term trading is most likely the method to implement right now if you are able to change your methods in response to the current environment in the market and in the economy. That was my personal quest during the first half of this year, and for me now the question is has been mostly answered. I was exploring portfolio management techniques, intermediate term, 1 to 3 months, expressed through options. And now I understand that the market in which you are supposed to trade, traders market, is here to stay, and quite likely it will persist for longer periods of time. Now back to the economy. I think that the reason behind such behavior is twofold. The first thing is that right now there is the market is still deciding about the overall perception of Donald Trump's administration. We all know that these people were elected on the premises of reform, of cost cutting, of battling illegal migration and potentially fixing other problems of American economy and society. And it's a reform government, and there is a certain cycle in the perception of reforms, which is which could be described like this: they often start with euphoria. Everybody is happy because now we have new people who will fix everything and it's good. And then euphoria starts to wane slowly, and then it transitions to sadness because reform means change, and that means that status quo is challenged and most likely will stay challenged. And after that, people usually want to go back to how it was before, but it's too late because the situation is already in motion. And I think that right now the markets are somewhere between the second and the third phase. They have experienced reforms in action, being them being deployed rapidly and harshly, and now they want and they largely bet on the situation staying more or less the same in the coming years. And that could actually mean that the process of rebalancing of global capital allocation could slow a bit. By this rebalancing, I mean that the U.S. stock market was largely consuming all the liquid capital in the world for the previous 2 years, and that was about to change. That started actually to change. I've pointed out strength in British pound and euro, and this is one of the most pronounced setups in the market right now. I mean, uh, these currencies breaking out and dollar weakening as they gain ground. So that that could slow a bit if it turns out that all these reforms are largely verbal interventions with the actual workings of the bureaucracy, the state bureaucracy and corporate bureaucracy in the states will stay the same, and the tariffs themselves could also uh, be way smaller than the market expects. And not only that would make the rebalancing of the global capital allocation uh, slower, they won't stop it. So Europe will receive more capital in the coming years, but that process could not be that fast now. Uh, and in short term, that means that the best that the American stock market has to offer, namely technology stocks, technology IPOs, will shine again like it was before in the coming years in the best of these years. But that could also mean that in intermediate term the situation could actually get worse, because that would mean that the debt situation is not going and it is here to stay. That is basically the problem behind the formal problem behind the fallout of relationships between Donald Trump and Elon Musk. The deficit is about to expand, and how are you supposed to pay this deficit, the debt? I'm sorry. So there are no obvious answers to that, and that is not the topic of the current discussion. To summarize, I just wanted to point out that it seems right now that the market is more or less betting on the current situation to stay the same. I mean, the situation before the Trump was elected. And in the near term, that is good because that is tradable. And on the long side, and that could actually bring more money into the market and help the AI cycle to express itself fully in the stocks, in the names which are related to the second wave of adoption of AI. But at the same time, that could mean bigger problems later in in the term of 1 to 3 years, maybe. Maybe they will surface during Trump's administration, maybe later. So that's the main takeaway for this week. The other thing I could point out is that we still are, since we are still in the decision mode, the things which could bother the market in the short term are better be figured out in the coming months or so, because the macro data is coming in mixed. We're still seeing good payrolls, but at the same time, uh, ISM indexes are getting a bit worse, sort of in the contraction territory. The manufacturing PMI came in worse during the previous week, and that will start to creep in into the employment, and we will start seeing that in payrolls, because payrolls, they lag a bit behind the ISM. And if that would not be the case, and if the status quo would not be retained, it could be challenged in a productive way, which could mean that the reforms are being carried out, that tariffs succeed, and manufacturing is being reshored. But it could also be challenged in a bad way. That means that the status quo is gone, but there is no constructive settlement of trade negotiations, for example, or there is a political crisis. And that could really scare the market, and that could prompt up a full scale recession later this year, basically, as Elon Musk says. So we'll see that. For now, it seems that, as I've said, the dips are viable, and short-term trading of the best of what American market has to offer is the way to go. And to sort of finish with what I have mentioned already, my personal answer: I was exploring a different methodology of trading during the first half of this year, as I've said before, because I have different data sets, different methodologies, which are being laid out uh, very factually. And my personal choice, as I've said, is short-term trading, because unfortunately the classic portfolio approach is not able to address the current situation, because the fundamentals are changing. Changing uh, is not the best way to say it. The fundamentals aren't able to catch up with the news flow, and there is a good chance that it will be like that in the coming years, or maybe even longer in the market. Everything could happen, obviously, but short-term traders market will persist, and being able to react to stuff that's happening short term is crucial to navigating this current environment. The environment, which could be named transitory. We were supposed to live in the era of transitory inflation, and the inflation is more or less tamed now. But who actually knew how transitory it was? Like, nobody. And we don't really know how transitory this trade situation is, and we do not know how transitory the political uh, quarrels within the states and outside the states too are. So that's why trading short term is the answer. And that is good for traders, but also that's not the best environment for investors. If my words sound untrustworthy, you could dig the period which the American economy went through in the 70s. The oil crisis, the persistent inflation. The oil crisis obviously was accompanied by political tensions. So there is nothing new under the moon, really. So, and things like that happened before. And I'm not even mentioning worse conditions like recession, going into depression and persisting. Obviously, a Great Depression is so big and scary that it has been overused and nobody is afraid of it anymore. But that is also a possibility. And what are you going to do that in that period of time? Obviously, trading short term would be the only way to address that market. So, the best way to respond to global uncertainty and external uncertainty overall is being able to derive some internal certainty. So that's the best I have to offer for this week. Let's be in touch. Bye bye.